Welcome back to Money Movers. Let's turn to the commercial real estate sector. As rates remain elevated, some new exclusive numbers are giving us a look at rising modifications and rising delinquencies as well. Diana Olick has more on the possible ripple effects. Diana, how bad is it?
Well, Sarah, as the pain in commercial real estate drags on most acutely in the office sector and the prospect for significantly lower interest rates is pushed further out, we're now seeing a big uptick in modifications. In fact, in the first quarter of this year, there were $1.42 billion in office loan modifications, a huge jump from the just $117 million in the same quarter of last year. And this is all according to new numbers from Trepp. Analysts there say that is not a good sign for the market.
May put a Band-Aid on the current environment that we're in, but it really just transfers the risk down to future years where, borrowers are hoping interest rates are lower, they're hoping occupancies are stronger. But the reality is in 12, 18, 24 months, which is the typical extension has been, I don't see a lot of changes happening.
And borrowers have to pay a lot for these modifications, and the terms are short. The incentive had been lower interest rates, but that's not happening as quickly as most thought. So looking forward, there is now less incentive for additional modifications. And this is also not a good sign for lenders holding the bag, like Bank of America and Wells Fargo.
If they start getting the keys back, I would expect some additional government intervention or some sort of stimulus or some sort of public-private partnership to really try to save and stimulate that side of the CRE equation.
Now, Trepp expects office loan modifications to increase through the year as there's about $30 billion worth of maturing CMBS office loans left in this year. Overall, CMBS delinquency rates surged in April to the highest level in 2 years. Back to you guys.
Diana, I wonder, when it comes to so-called rate cliffs where a lot of stuff needs to be refinanced, do we consider 24 to be a peak, or is it 25 or some later date?
Well, as we said, there's a lot that need to be modified in 24. There is also a lot in 25. It's not so much the cliff. It's the fact that even when you push these out, and it's this extend and pretend strategy, if you push it out 12, 18, 24 months, and you get even into 2026, the rate at which interest rates come down make it less and less enticing for them to even do these modifications, because they're never going to get to the level where they need to be. If they started at 3%, maybe they're at 5%, it's not going to help. So then you have to wonder, are they going to hand in the keys?
What would the guy mentioned possible government intervention to stem the tide. What would that even look like, and is anyone talking about it?
I mean, this is the first that I had really heard a lot of talk about government intervention. But if you have this kind of distress in the marketplace, I mean, during the Great Recession, we saw this when people were handing back the keys in residential real estate. But now if you look to commercial real estate, and specifically office, which not only needs modifications, but really needs a whole reworking of that sector to get older buildings up to snuff, to make them even desirable, that could need some intervention.